institutional investors are willing to tolerate short-term pain of demonetization for a period of around 6 to 9 months. That's the word coming in from Robert Buckland, the global equity strategist at Citi. Here's an excerpt of that exclusive chat with Lata Venkatesh on the government's cash cleanup drive and where India stands in the emerging market pecking order for Citi.
But global investors are looking at the longer-term picture. I think they like the motivation for what is occurring here in India. They like the economy coming online and all of these sorts of issues. Increasing efficiency could come as a result of that. So they like that story. The question for you guys is that if it leads to a shorter-term blip in the data, are my clients going to be tolerant of that in terms of improving the longer-term picture? I think for now they will probably be willing to do that, but it can get choppy.
So would it be that long only stays put for now, but ETFs move out of India? I
think that's probably a good way of terming it. I think the longer-term investors that I speak to, they like the long-term philosophy behind what's occurring. The shorter-term investors that I speak to will be trading whatever the companies are telling us about the shorter-term impact. But I think the longer-term guys are the ones you want investing in your stock market because they're here to stay. They're the ones who are backing the longer-term strategies of your companies here. So I think most of them are willing to look through this.
Okay. As a veteran watcher, how long will your patience hold with respect to India?
Each one of my clients have a different time horizon. But I think for the ones who you should really be looking to attracting, investing in your companies here, I think that they're very definitely investing on a 3 to 5 year time horizon. So if you get weaker data over the next 6 to 9 months, they're willing to look through that, and I very much endorse that approach.
Okay. What about what you will watch in these 6-9 months? I mean, earnings, of course, is one thing.
Sure.
But we really don't know how several macros will play, how the M3 will contract and then expand or be allowed to expand. We don't know how much of the money that doesn't come back to the Reserve Bank may be pushed on for fiscal stimulus. Will you worry, for instance, if the Indian government said that fiscal deficit for the next year is not going to be from 3.5% to 3%, but rather 3.5% to 4% because we need to stimulate? Will that be a big negative?
At the margin, it's not helpful, of course. But I think let's say look back to 2013 when all emerging markets got beaten up as the Fed was potentially looking to taper its QE policy, and the markets were last looking to a tightening in policy. One of the things that my clients look for at times that financial conditions are tightening around the world are things like current account deficits and so on, i.e. economies that are reliant on global capital flows. Again, one of the positive things about India is that you've improved your current account situation over the last 3, 4, 5 years, and that makes you less vulnerable to capital flight than other emerging market economies that have not cleaned up their act over the last 2 or 3 years. So I would say that, again, I think the big global investors are willing to look through some of the short-term problems that you may get out of this radical change in policy. But the current accounts is something they watch very closely, and you guys have cleaned that up over the last 2-3 years, and that's a good thing. Would
India be a relative outperformer in an otherwise underperforming emerging market basket?
Yeah, we think generally India is better placed to deal with the difficult theme of the rising dollar for emerging markets than most other EM.
All right, then with that, it's a wrap on Chartbusters.